Trump administration makes a new 960 billion offer as a stimulus to the economy, in particular to the state and local governments. The European Central Bank also announces a 500 billion support plan to buy out outstanding bonds and support cheap finances for banks and financial institutions. How will all of this affect the global stock market and, more importantly, your investment portfolio? What's up everyone, my name is Joris. Welcome back to my channel. In recent weeks we have seen a lot of good news on the global macroeconomy. Several vaccination treatments have been found and are getting mass produced. Some countries are already vaccinating their residents. The end of the global pandemic might just be on the horizon. Of course, it will still take weeks and probably months before we get our daily lives back. But, at least for now, there is an end to all of this. However, there still will be great consequences to the economy in the near future. Several sectors have had a severe impact on their revenue and a lot of small companies have had money problems. There is no denying that there will be a lot of bankruptcies in the coming months in the tourism sector, in the event sector and the cultural sector as well. Let's hope that these sectors will survive and that they will soon regain their momentum. I really miss going to concerts. In the short term, we will see these problems in the economy for quite some time still. A lot of companies will go bankrupt in the coming year, which will have a bad influence on the overall economy. Luckily, the central banks and individual governments do whatever they can to support the economy and save some of those businesses. It's not the end of the world if some companies go bankrupt. Zombie firms are holding the global evolution of the economy back. So if some of the zombie firms are finally closing down, that will open a window of opportunity for newer companies. Lately, we have seen a great discrepancy between the stock market and the actual economy. The huge support plans of the governments and the central banks are initiated solely to try and keep the economy from crashing down, while it is actually also supporting the global stock market, just as we have seen earlier this year. We have seen a tremendous drop in the economy in March. Import dove, export crashed, and the stock market crashed down as well with a 40% down. But after that, a lot of financial support was sent out to individuals and individual companies. Okay, the economy has had several bad quarters with a lot of losses in revenue and profit. To this day, and even in the near future, a few more bad quarters will happen due to the pandemic. But in contrast to that, the stock market has limited its losses by June and is now even reaching new highs. This shows us that nowadays the stock market and the economy are not that intertwined as they once were. So, what will the future bring then? We will most likely see another few months of economic problems, but these problems will be limited to local and smaller companies. The bigger companies are able to lend out more money to postpone their bankruptcy, and thus they will probably survive. Because these bigger companies will be surviving, the stock market will continue to thrive as well, and its return will at least be better than the global economy. Apart from big monetary support, we can also see that America is waiting for some kind of fiscal support, meaning there could be changes in the way their taxes are being calculated. With the new president in January, there are a lot of talks of doing just so. In Europe, however, we saw that this week the European Central Bank supports the economy with another 500 billion euros, a support plan that will stay active throughout the course of 2021. Meaning that the interest rates will also stay at an all-time low for at least the next year. But what does this actually mean, supporting the economy by printing money? The European Central Bank will buy government bonds and corporate bonds with newly printed money. So basically they are supporting the downside of these bonds and companies by making sure they are being bought up. In a way, they give money to companies at very low rates to help them overcome these problems. And on the other hand, they lend money to banks, governments and financial institutions at a negative 1% interest rate, basically giving the banks and government free money. They have to pay back less than they got in the first place, but only if they use the money in a correct way. They can use the money to invest in the country itself, or in the case of banks, by giving out loans to companies that really need it. The free money that governments get has to be paid back eventually, and most countries have had an enormous debt the last few years, even though the money they lend is cheap or even free. And since they only finance the interests yearly, it is still quite manageable. Since the central banks are now printing extra money, trying to boost inflation and keeping interest rates low, the governments are basically making money on the money they are lending. Belgium, for example, has made 207 million euros in negative interest on its loans that have had less than 17 years outstanding. If governments then are extending their loans ad infinitum and they only pay off the required interests, the loan will always shrink due to inflation. This is a very common used strategy as well. The European Central Bank has a global goal to keep the yearly inflation close but not at 2% yearly. But in current times we can even see a small deflation. The bank further expects an inflation to pick up at 0.2% in 2021 and to 1.4% by 2023. Because of all of this, I expect that the coming months and the rest of 2021 will be less volatile than 2020, obviously, but not completely at ease. The economy will start to regain traction and start to grow again by the mid of 2021. The recovery of the markets has already been ahead of the recovery of the economy. So I think we will not see a lot of returns over the next year. The economy has to catch up with the markets again, or the stocks have to come down. But due to the huge money injections we have seen recently, I don't expect the stock market coming down a lot anytime soon. Gold will drop since the uncertainty on the markets will go down over time, which already has been happening for a few weeks now. We also saw several sectors that have been flourishing the last year, most of them in the digital and service sectors. These specific sectors will continue to thrive, as there will be a permanent shift to online businesses in the future. Local businesses will come back, but they won't be as strong as they were before. And the same goes for all the other sectors really. For example, oil. Oil will come back eventually, but the returns will be limited. People will work more from home, they will travel less for work, and they are maybe inclined to buy electric vehicles over an oil-fueled one. So a definite shift in sectors will be visible in the near future. So technology will be a better sector in the future. A lot of these stocks are actually quite overpriced and overhyped right now. I am expecting a correction on those in favor of the stocks that were just left behind, like the oils. But that's just my 2 cents. We'll see about that. So, tell me what you think. Do you think there will be a switch from oil to electric, or don't you think it won't be happening that fast? Tell me in the comments below. Since I believe there is a change in which sectors will thrive the coming years, I will allocate my portfolio accordingly. Next week, we will look at how you can look for sector-specific ETFs and investments to ride along the waves of a promising flow. Be sure to be subscribed by then and to have hit the notification bell to be alerted when that video comes out. If you have enjoyed this video, you know what to do. So if you want to continue watching, be sure to click one of these videos right here, and I will see you in the next one. Cheers!